Well, last week was all about Nvidia, and this week it's all about Bitcoin and the crypto scene. With TradFi markets lacking a pulse, we've seen traders really gravitating towards markets with more extreme movement. Now, we look ahead towards March and we ask whether the landmines that we see above us will see greater volatility coming through in equity markets, in rates and FX markets as well. We also look at trades around gold and crude and FX markets. It's time to get in front of the screen. This is the trade-off. Well, hi there, my name's Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. There's a bit to discuss. I know the markets are lacking a bit of a pulse across sort of more traditional markets, FX markets, equity markets and rates. But we are seeing movements, and I think the tides of change are potentially upon us as we go into what's going to be a massive month of event deluge coming through in the month of March. So, Mr. Blake Morrow, I'm going to bring you into the programme. I'm going to go over these factors of March in a second, but how are you reading the markets at the moment? Pretty quiet, or are you getting excited about potential movement? How are you adapting to this low vol environment?
Well, it is very low vol. We are just nudged right up here against the highs. I am a little, I'm thinking that tomorrow's PCE is going to be a market mover, and I think we have a couple of setups that would reflect that. And I think that the market is looking like we're going to explode in volatility soon. But I've been thinking that really the last couple of weeks. So I know we're all hoping. I pray nightly. It was interesting. I was having a conversation with one of our traders. He's like, we are a sixth through the 2024 already, and it's been nothing thus far. But 2024, there's a lot left in it, Chris. There is.
Well, I'll tell you one thing that just completely epitomizes the fact it's low vol. We're going to be talking about the government shutdown today. I think that really just sort of epitomizes everything then. But you know what? I do think, in these times when people want move, obviously the movement is really reliant on your strategy. If you're a fund and you want income, you're going to, you quite like these times where you're getting low vol because, you just go and get paid and you're going to carry or relative value trades. There are ways to adapt, of course, but for someone who trades really short term, I like a bit of range expansion. I like volatility like the next person. So we hope that happens, but you've got to adapt. We can only trade what's in front of us, right? That's all we can do. And
the market, that's it. You can't pick and choose the markets. And I learned a long time ago from my mentors that you have to be around during the bad times or the low volatility times to be around for the good times too. So
who's that? Jim Simmons?
No, but it's a true statement, right? I mean, you have to be around. You might be doing underwater basket weaving, waiting for the market to move, but you got to wait. And when it moves, you got to be able to pounce.
That's right. I mean, we saw last night everyone just gravitating into crypto. We can talk about it in a second, but our volumes in crypto, certainly in Bitcoin, are about 11 times what we'd usually see. So obviously, people want movement. They're seeing that in the crypto space. So yeah, obviously, we'll see if that continues. But I'd like to see FX vols pick up a little bit. These things don't happen overnight. But let's go into the show now and actually let's have a look at what's going to cause that. Let's go to Topical Thunder. Let's bring up crypto. It's been a wild ride. I mean, you can go into some of the altcoins which are having some big moves. I mean, Doge is now sort of ripping, and some of the other markets are doing pretty well. But of course, it's Bitcoin which gets the sort of lion's share of the attention. You can talk about the over $6 billion that have gone into the 9 or 10, well, the 9 ETFs. I think Grayscale Trust has had outflows, but there's been massive volume going through there. Everyone's getting excited about an Ethereum cash ETF. It's a question of when, not if. People are talking about the halving that comes up in April, all these sort of factors. And then you've also got, interestingly, a very strong, very, very high correlation coefficient with Bitcoin and actually sort of junk equities. Most short baskets, they're sort of 93% correlated with Bitcoin. So maybe it's just a high beta play as well. But I do think there's idiosyncratic issues, which I'll just mention there as well. And of course, it's a momentum beast. I know the options market is small fry, but if you look at the upside, it's really been all upside call buying. And as price moves up through the strikes, dealers have had to hedge their exposures because they've sold the calls, and effectively that meant buying the underlying as well. So it's just been a big momentum shift as well. But I think overnight, Blake, we've just seen some incredible volatility. I think Bitcoin traded a 5,300 point drawdown at one stage. The elastic band had been pulled up as some of those leveraged longs got liquidated. But I still think it goes high. I think we test the all-time highs. I want to see a little bit more of a retracement just to get some of that froth out of the market, and I'll look to rebuy. But nothing's really changed here. How are you trading it at the moment, if at all?
Well, first of all, I'm not trading it. I'm just watching it jaw dropped and watching the whole move unfold. Although you said something interesting. You said even Dogecoin was up, ripping.
Well,
I learned a long time ago.
Yeah.
I mean, okay. I learned a long time ago when the poop floats, it's usually you're about done, at least near term with whatever moves you're seeing. And I would call Doge poop. All right. So
Doge is poop. I don't know if Bitcoin is though. If you call Bitcoin poop, you're going to wake up with
I don't. And I actually am quite bullish, and I agree with you. I think that Bitcoin's eventually going to all-time highs. A couple levels that were hit today. Ethereum from all-time highs to, I think, 2022 lows. We just hit the 618. We rejected it. We traded past it today, but we closed well below it. Bitcoin stopped at the 88% retracement of the all-time highs to the 2022 lows, which stopped us around 64,000. I think that's going to cap Bitcoin near term. Now, do I think that they're shorts? No. But what I would be looking for is I'd be looking for strategic levels to be on the long side. I think now that we've gotten that first surge out of the way, it looked very impulsive. If you talk from an Elliott wave standpoint, impulsive moves are usually directional. And they're ones that you have to respect. So this big move that we've seen in crypto, I'd be looking to buy pullbacks. Let's see how Bitcoin reacts on any dip if we get lucky to 53,000. And I think that's going to be the tell.
I think that's a lot. I mean, obviously it's just been good news after good news after good news. We saw MicroStrategy coming out and averaging, I think their average price, they got 3,000 coins or so over the month. And again, it's just a consistency of good news. I think one of the hard things for holding has always been the regulatory environment. I think people are saying that the regulatory environment's a lot safer now to be holding crypto from a sort of a news perspective, and saying the two biggest risks to holding crypto for a big drawdown was either profit taking in itself or some sort of macro event, like we were to see, a spike up in real rates that caused equity markets to draw down. And if we were to see a proper, drawdown and a VIX spike, then perhaps crypto as a high beta asset would come under pressure as well. So they're probably the two big risks. And prior to that, it was always, regulatory risk was the big issue. And I think people are seeing that dissipating. So that's been another trigger. But there's been good news after good news. And Bitcoin and crypto feeds off sentiment. So yeah, I think buying dips remains still the right trade there for me.
I agree with you. I'm with you on that. All right, so let's go to the next topic, and I want to talk about Japan, and I want to bring up a chart. I'm going to have the producers bring up this chart of this 2-year yield in Japan, and what you're going to notice when you're looking at this chart is that we're touching levels that we have not seen since October 30th of 2023, and this is. And if you don't know what happened in October, that was when the BOJ met, and there was a big meeting, and there was expectations that the BOJ might move then. And look where 2-year yields are at right now. There's a lot of talk that yields have gotten up to levels we haven't seen since 2011. I believe is the number.
17.
Yeah, it's gone up quite dramatically, and so. This is following this week where CPI, Japan CPI came in slightly above consensus expectations. So, I'm wondering if this is the market preparing for a potential shift from the BOJ. And I think that's, we're going to be talking about some of the risks that we're going to be looking ahead to. But I think that is, and I'm just going to name it right now. Sorry, don't mean to step on your next segment, but I think that's one of the risks right now as we step into March is a BOJ risk. But are you reading into any of these higher yield moves in Japan? And we are seeing higher yields obviously in the U.S. as well. But how are you reading this, Chris?
Well, I think it's an interesting point. the move at the front end is something that's more controlled by the market. You know, they control. I know YCC is kind of all but dead in the water, but you know, I think that the market has the price discovery in the front end of the JGB curve is there, and you know, you have seen that move as the chart shows. You've gone from around effectively 0% to 17 basis points. We won't work that on percentage basis because it doesn't work like that. But you know, that has been a reflection that people are preparing for changes in Japan. And I think the key date that you need to have, I mean, you point out the CPI number, that was hotter than expected. But the key date now that any kind of any BOJ watcher, anyone who's got a yen exposure, Nikkei exposure, is the 15th of March. That's when we're going to see the wage negotiations coming through. We're expecting, you know, wages to sort of be up around 4%, base salaries about 2.5%. But the Bank of Japan have made it very clear that they're going to change wage. That they're waiting for these spring negotiations and the numbers before they change. So, if those numbers are hotter, then there is a possibility that we could see a removal of zero interest rate policy and effectively their interest rate going to zero from negative 10 basis points. And that could happen on the 19th of March when the Bank of Japan meeting. Whether that sends any kind of ramifications through the yen, I don't know. It doesn't suggest they're going to. There's a difference, Blake, isn't there, between actually just moving out of zero interest rates and tweaking what's already the YCC program that the market doesn't really give much concern, or actually going on a rate hiking cycle. If they were to go on a rate hiking cycle, then the yen is a screaming buy, an absolute screaming buy. It's cheap, but the market's just saying probably, you know, if anything, we're just going to get them going out of negative interest rates, which is symbolic and has some gesture, but they're not. There's a big world difference between them moving out of ZERP and effectively going on a hiking cycle, right?
Right. That's exactly right. And so I think you point out a great date, March 15th, wage negotiations. And what does the BOJ do just days following that? And I think the markets get on the cusp of just kind of pushing the envelope here.
But just one quick one, because what's really important for us as FX traders and traders more general is positioning, right? And if you look at the market, the market has been piling into yen shorts because they wanted to fund, you know, the positions through carry, and obviously we've seen dollar yen up into 150, you know, Kiwi yen into highs. So the yen crosses have been have rallied hard. So the market's obviously very short. So the question is even though it's symbolic that we potentially could either in the March meeting or probably the April meeting as well, one of the two, it's going to happen in one of those two, depending on what happens to the wages, could this short positioning readjust and cause a significant move in the yen just because of a positioning shift, because the world is very short of yen? I mean, that's an interesting point in itself, I believe.
I believe so too.
Yeah, so positioning obviously plays into our risk reward. But let's go into that March risk, because we can talk about realised and implied volatility in the FX markets effectively at 2-year lows, regarding of the tenor that you're looking for, weekly vols or 1 week, 1 month or whatever. You've got the VIX at 13%, just above 13%. Bond volatility is very low. I mean, look, crypto volatility is actually quite low. You know, I know it's going on a rip-rolling trend, but the actual close-to-close percentage changes have actually been very rarely above 4%. So actually there's not statistically very high volatility in crypto at the moment, in Bitcoin anyway. But let's go into what we're seeing. 4th of March, Blake, I'm looking at the Swiss CPI. This is for an FX, because if that's weak, it does open the door to a Swiss rate cut in the March meeting. And I know a lot of traders are just waiting to short the absolute bejesus out of the Swiss franc if we get a weak Swiss one. So that's, for me as a currency trader, I know I want to sell the Swiss franc. We just need to see a weak CPI number, and then what we're going to see is the Swiss National Bank leading the charge of rate cuts coming through. I know we've been talked about the Canadians at one stage, the ECB, but if we get a weak CPI number, that's going to be a big one. Well, on the 5th, the day after, we've got the People's Congress coming out of China, where they're going to be coming out of their definitive targets, and I think that's going to be very, very important for China watchers, any China market, and I think any China proxy is going to be watching that one on the 5th. You've got Powell speaking on the 7th, you've got non-farm payrolls on the 8th, you've got the CPI number on the 11th or 12th. We talked about 12th. We've got the Bank of Japan, the wage negotiations in Japan on the 15th. Nvidia, you got their GTC conference when they're going to come out of their product suite on the 18th to 21st. No more important stock in the world, and the market's going to be looking at that very closely. You've got Bank of Japan on the 19th, and they've got the Fed later on as well. So look, I'm looking at that CPI number in the US. I think that's going to be important, but I've talked about some other factors there. which one of those you think could cause volatility, if at all?
You missed one, Chris.
Go on, tell me. Shit.
Nigerian budget comes out. I'm joking. Joking.
Well, actually, I actually saw that the Chinese piano sales are down at like 5-year lows or something. Maybe that's one of the reasons.
Oh my God, that's crazy. That's almost as bad as doing the New Zealand visitor arrivals, I think. Okay. Anyway, so you named off a lot of the risks. I think other risks are UK political risks. I know our colleagues over on the UK trade-off have been discussing that and discussing the maybe the prime minister shuffle that we might get coming up. I think that's a big one. Obviously, we're going to talk about a potential U.S. government shutdown, but I'm going to hold my comments there because we're going to talk about that here in the next topic.
We got Super Tuesday as well, but I think we pretty much know who's going to be, the running for president in both cases. I mean, it's pretty much done, isn't it? So
yeah, and that is going to be March 5th. March 5th is Super Tuesday, which is next week. And then we also have, I think you mentioned retail sales. We have retail sales, U.S. retail sales of the 14th, CPI and jobs, obviously next Friday. So a lot of key components, and I think March sets up for being, oh God, I don't want to use the basketball terminology, but I can say it. March Madness. It's going to be
Ides of March.
The Ides of March Madness, maybe. But just clump it all together.
I think you've made some points about the UK, but for me, after the high CPI number, we're saying this before the PCE number comes out. Obviously, if that's hot, that sets us up. But if that CPI number comes out like 40 basis points again on core month on month, then this idea that the January numbers, were seasonal, idiosyncratic. We get 2 in a row. It's not a trend, but I think that really puts the market on edge to say, hang on a sec, these 3 rate cuts that are priced in by the end of the year, maybe they don't deserve to be that. I think the market, I've said this before, the market is happy to see rate cuts coming out of the market as long as it's driven by better growth. If rate cuts are coming out because of the right tail risk, because of inflation concerns, I don't think the market can hold these levels at the moment if that's the case.
Great point, Chris. Really great points to drive home there. And the higher for longer might mean higher for a lot longer. And, so that's something that we should be thinking about. All right, let's talk about my favorite subject. This is what happens when the market goes into a lull at all-time highs. We have to talk about U.S. government shutdowns. Now, are we at a risk? Well, first of all, let me take a step back. We are at a bit of a risk. So we have U.S. House Speaker Johnson. He's working to try to prevent a shutdown. But if we have a shutdown at the end of this week on the 1st, that's not the end of the world. It's not the end of the world at all, because it's only going to be a partial shutdown. The market's going to slough it off and realize that something's going to get done ahead of the next Friday, which will be the 8th. Now, that isn't even the end of the world, in my opinion, either. But for us that like to trade on data, that's when it starts to matter, because if we don't have a deal by the 8th, which will be the following Friday, then we stop receiving. We won't get that CPI data.
We won't get the CPI and all that stuff that we just talked about. I mean, all this stuff that could be a volatility driver we don't get, right? So
yeah, and so
that's where it becomes frustrating.
We are, and I know I've said this, and we've talked about it. You and I, we've talked about it here on this show multiple times over the last several months. This year is going to be a political tornado event, weathering event that we're going to have to weather as a whole. Going through these negotiations and trying to get both sides to line up and agree on things is going to be increasingly difficult in this environment where we have two sides that are so far to the left or right. I can't tell you how many Americans I talk to that are so much in the middle and they just don't want to vote. And they just don't want to be on one side or the other. Just they don't, to find some sort of moderation. But that's how polarizing it is. So as we go into like government shutdowns and negotiations, that becomes a tail risk in itself, because I think the markets are underpricing the fact that things might not go as well as they've always gone. So anyway, Chris, that's how I'm looking at the government shutdown. I'm not too worried about it yet, but that's why we talk about it on Topical Thunder now, because it might be an issue coming up. What are your thoughts?
Look, I think, Speaker Johnson probably gets a deal away. They'll just keep coming out with these extensions, these spending bills that get pushed through temporarily, and then we readdress it. I mean, I think it's the third time that we've gone through this situation, and the market's just over it. They just don't really care, to be honest. But maybe this time is the time when, Johnson can't get bipartisan agreement short term to get something done. But you're right. I mean, if we go past this, we get a partial shutdown. It doesn't do anything. If we go past that 8th, then we don't get the CPI print. I think we'll get the payrolls number, but we might not get the CPI number and and the PPI number. So that's a worry, because I'd like to, obviously we want to see that, and it'd be frustrating to get that later on. But I mean, once we get the full shutdown, then of course, it does start shaving off growth in the short term, but then that growth will be given back at some stage. But like any of this stuff, if we get into a worst case scenario, there's a natural handbrake in government shutdowns, because you just can't not pay the military, active servicemen, for a period of time. There's people you just can't pay for a period of time without it actually backfiring significantly and causing outrage. So there is a natural handbrake on how long it can go on for. But I think every week that it goes on, we'll shave a little bit off growth, but then it will give back in the future. But I think the worst this is for me is that we don't get that data, which could cause volatility, and that just becomes frustrating, because we want it right here, right now. We need to know, and we can price risk much more efficiently in that situation. So, I think it's going to start coming on people's radar, but obviously, it's not a massive landmine for me, but it could cause some frustrations in the data releases. That's why I see it. Anyway, let's go to that's a setup. I want to bring up the VIX Index. Baby. Not because I want to do technical analysis on it, because if you do that, you get chastised, taken out the back. No, I've just drawn the average here because, just to give you a reference point of how things have gone over. Obviously, that was skewed towards that big spike that we saw in October, November, but that we have come off a little bit off the lows. And I think it's interesting that the sort of, if you look at the VIX, and you can actually use the VIX to work out the expected move over a period of time, and a VIX at 13.8% gives you an implied move in the S&P over a week period of 2%. Their daily moves of about 0.8%. There's some funky calculations you can do, which I can put into the comments section if you're interested in working out. The VIX basically tells you the expected movement over a period of time. So the market's implying at the moment that we're going to see the S&P up and down 0.89 of 1% every day. I'm not sure if we're getting that situation, 2% over the week. But what we're also seeing, Blake, is a little bit now of hedging coming back in. If you look at S&P 1 month put implied volatility and subtract call volatility against that, it's been at very low levels, showing that traders have rolled off hedges. That's pushed up a little bit now. The question is, as we go into March, will we see the VIX push up into that average around 15%, which I think is so important. If the VIX is going up, realized volatility is going up, you see a lot of these volatility dynamic funds taking cash out of the market, and that will cause higher volatility in itself. So a little bit of higher vol that we're seeing there. But do you think that we see the VIX into 15% as we go into March? How would you position there?
I do. I actually think that the volatility, as you point out right here, and this chart's very, very easily shows exactly what the risks are, that right now volatility should be trading down towards a 12 handle, and it's not. So I do think that with all of these, potential, like you like to call it, using your terms, landmines that we have in the month of March, I do think that the risks are for a spike higher in volatility. Now, let me just also be clear. I don't really get worried about volatility unless we get a sustained break above like 16, 18. Then I start to really think, oh crap, what am I doing here? And how do I protect myself? Right now, VIX is at historically low levels, but I do think the risks are for a potential spike higher. And so, for you VIX volatility call buyers, that might be a nice trade setup. And that's why it's on. That's a trade. That's a setup.
Well, I think exactly. But I think people buy, a lot of funds buy calls in the VIX over buying puts in the S&P because the convexity that you get from that. So you actually get a better move. So if you want to like hedge your portfolio or look for outlier positions, then you buy calls in the VIX effectively, and you get a bigger move. The problem of just going and buying it outright as a generic trade is that everyone wants to sell volatility because you've got the Fed put in the market at the moment. You know, why buy volatility on a sustained basis when, you know, if there's any kind of shit that happens in the market, the Fed's just going to sort it out, adding liquidity or cutting rates. You know, you've got a big Fed put in the market. So, you know, buying the VIX for a 40%, 80, plus move is tough to do. So, yeah, good to trade. But yeah, I think people are, funds will be buying calls in the VIX over buying puts. And that's why you're not seeing much in the way of like downside protection in the S&P at the moment.
That's right. All right. Well, good, great setup, Chris. I actually really like that one. All right. So my first setup is actually going to be gold. We hear your cries here at the trade off, and we know that you guys and gals love to trade gold, and especially with all the attention being on Bitcoin, I didn't want to leave you guys and gals out. So I wanted to bring up this nice little pivot at a 618 retracement. We've been hugging literally the 50 DMA. You can see it right there, that orange squiggly line that we're just sitting on. We've been hugging that for the last few days. Well, guess what's tomorrow? Tomorrow's the biggest data of the week. It's the PCE data. Now, I personally, and I'm just going to say my personal opinion is the data is going to come in a little hotter than the market really wants, and that should bring in a lower gold price. That means gold should probably slide back down towards the 2000 level. But if I'm wrong, and gold trades above, let's just say 2045, we trade above a channel resistance, we should be challenging that 2075, 2080, that previous triple top. But I think we can make our way up there. I think this is a beautiful pivot to trade. It's a great setup in either direction, because I have my opinions, as we all do. Like, we all have belly buttons. I have an opinion, like a belly button. And I'm going to voice it, which I think the dollar is going to go higher and gold's going to go lower. But that doesn't make me right. And I think that this gold market sets up for either direction. Chris, what are your thoughts on gold here?
I mean, I think if you're a gold bull, and as traders, we just trade what's in front of us. Is like, I mean, you've got to be infused at at how it's held up with known ETFs coming out of the market, with real rates pushing into 2%, with rates pricing out to effectively go from 7 rate cuts to be on the equilibrium with the Fed's dot plot projections at 3.5. And it's held in really well. So you've got to be infused by that situation. I think probably the lack of movement in the US dollar has probably been quite helpful there as well. But you could easily make an argument for gold being $50, maybe $100 lower than where it is at the moment. But it's held in well, so that's positive. Look, I think the core PCE number tonight is your playbook. The market there is kind of on the medium consensus is 0.4%, which is a hot number. A year ago, we'd be probably talking about rate hikes in that regime. But yeah, I think if you're to get anything above 40 basis points, well, let's take it to a 2 decimal point. Let's say anything above 0.45%, gold price gets hit. Dollar rallies. We probably get down to 3 rate cuts from 3.5 by the end of the year. Real rates push up a little bit there. So I think the gold price would not like that. But I think anything getting towards 0.3% on core, and we look at super core, given where pricing is, given dollar positioning, I think you probably see gold have a bit of a rally toss to test the top end of that upper band, that channel there. So that's probably the playbook I'd be looking at. And then we go into March, obviously. So I think I would actually argue that gold has a bigger rally on a downside surprise on CPI, PCE, than the sell-off that it would have if we saw an upside surprise in core PCE. Would you disagree with that?
I concur with that. Right. Yes, I agree with that. I also have to concur that gold has held up very well. You look at silver. Silver looks just grinding lower. It looks ugly, but gold, it's held up really well despite everything you just threw at it. I
think for now, though, ahead of that data point, the question is do I take exposures off over the data point? Perhaps going into that, just take it into a 30-minute, 15-minute chart and just trade a tight range, it's just going to do this right up until that point, and you can literally just scalp the highs and lows intraday. I think that's the way. So a lot of people will be watching the show, it would have happened, but for me right now, take it into a short-term time frame, just because it's just going to do that. It's just going to mean revert and trade a choppy sideways trend into that, and I think that's how I'd be looking at it. Anyway, let's go to SpotCrude. We've got that one. An interesting one, Blake, because I think you brought this up last week, and I just want to sort of... it's one that I've had a couple of clients reach out and say, where does crude become problematic? Now, we're trading in a channel. Could also say that's quite an extended flag, but we've got an inverted head and shoulders pattern. We're testing the top end of that. We've got horizontal resistance levels coming into $80 or so. It's just holding up and consolidating. It's just banging against that ceiling at the moment. If it breaks on a closing basis, I think we could probably be pushing 82 as a first stop, perhaps over time getting into $90. If it breaks that on a convincing basis, it could trend. We're not seeing signs of that at the moment. It is consolidating, and it delicately poised. Now, I don't think crude becomes a real big problem until we get above $95, perhaps for 100, and holds there for a while, because we're not seeing long-term inflation expectations moving up. We are seeing one-year break-even rates moving up, but long-term inflation expectations are still pretty subdued. So I'm not too concerned about the move with crude and the influence it has on headline inflation. But how are you trading this one technically? I know you're pretty consistent with your idea that you're a bad trader, but you're a good caller of crude. But how do you see this one?
Well, first of all, you said a magic number that's already in my head, which is 82. 82 would be a range expansion from 79 if we broke 79 on a closing basis, which is that descending trend line. $80 is a big deal, obviously, on a psychological level, taking us up towards your channel resistance that I think you have very well drawn. I think 82 is totally logical. Now, one of the friend of the trade-off, friend of the show, her name's Tracy Shukart. I actually met with her this last week, and I talked to her, and she actually thinks crude's going to be range bound this year. But I don't agree with her, and I actually think that your analysis is more succinct, where we could see a move towards the mid 80s, towards 90. I don't think the market's prepared for it, and I don't. And everybody believes that crude's going to be subdued because of OPEC and because of it's an election year. Somehow the magic hand is going to keep prices lower or subdued. I think the risk, as we pointed out the last couple of weeks, this is the Achilles heel of central banks. If we start to see crude rallying above $90 and we get towards 100.
Tracy's an expert in this world, and you and I are not fundamental experts in the crude complex. But to get us into $90, other than a geopolitical issue, it's hard to see demand. I mean, China's demand's falling. It's hard to see a fundamental reason other than a geopolitical issue and a supply issue that causes a move up into those levels, right? So we could, obviously, as technical analysts, we're not trying to forecast stuff. We're not trying to prophesize. We just react and trade the tape that's in front of us. But to get into $90, I mean, it's difficult to paint a picture of from a demand side to get up into those levels, right?
You're right. It'd have to be some geopolitical risks that emerge, but which were the world is full of those risks right at this moment. So who knows? A lot of times the market goes and it starts to move towards somewhere, and you're like, how did that happen? And you're like, oh, that happened. How'd the market know that ahead of time? Who knows, Chris? But I do think that it is wedging higher, and it looks like it could break higher to me. So
I'd like to be wedging higher.
I bet you would. Let's talk about the last setup, which is the Nikkei, and 34 long, lonely years for Japan.
1989. What would you remember out of 1989, Blake?
I was enlisting in the military, and in 1990, when the Nikkei hit all-time highs previously, I was, I think, in boot camp, a U.S. Marine Corps boot camp at that point. So that dates me a little bit.
I think David Hasselhoff was preparing to sing at the Berlin Wall, wasn't he?
He probably was. Anyway, but technically speaking, I just want to point out that we have completed a bull flag pattern. Now, when technical patterns complete, that doesn't mean anything other than if you're, like in this case, you're long, you want to protect yourself, move up your stops, take some profits off the table. But just keep in mind, the whole market has been really looking towards a stronger Nikkei, and it's been a big recipient of what's happened in China, I think, and because how the BOJ just really not wanting to move on rates. But we had this conversation about the BOJ and maybe the market's starting to anticipate. I'm not saying right now is the time you want to short the Nikkei, but we are just kind of meandering around those previous all-time highs that comes up around that 39,000 level, right around there, 39,000 and change. What I'd be looking at, look in the pane below and you'll see the RSI. Okay, that RSI can be very telling. It can tell you if there's going to be a continuation higher, which I still believe. I actually think the Nikkei is the place to be probably in the next several years. I'd choose to be in Japan over probably U.S. equities at this point, but that doesn't mean that we're not going to see pullbacks. And if you do feel that the BOJ may move, you think that, and I know I'm just using up all this time right now, Chris, sorry about that, but just watch that RSI, because if the RSI breaks down, I think that's going to signal that a pullback's coming. Sorry, didn't mean to take up all the time, but what are your thoughts here on the Nikkei?
I don't think I can add too much more. I think you speak like a poet on charts. But yeah, I do. It's been a fantastic place to be, and a lot of that has been down to the weakness in the yen. But if you price the markets in dollars, it's still working really well. Yeah, I mean, it's been a crowd pleaser. I mean, the positioning's rich. That worries me. It does look like it's topped out. I feel consolidation's the path. It doesn't feel like a hugely high probability trade to be short at the moment, selling into these levels. I'm sure people will be doing it, but you put me a gun to the head. Do I think we're going to see upside or downside? I actually see further down. I see heightened downside risks than upside risks at these levels for a number of reasons. Going into the Bank of Japan meeting, going into those wage negotiations, doesn't mean necessarily I'll be looking to put positioning on. If I did, it'd be very, very small size, to be honest, because the market is you're selling into a strong trend. So I wouldn't want to be fighting that upstream channel there. But I do see greater downside risks emerging for that market. Doesn't mean we're going to see a 20-30%. I'm talking 5% or so. So would I be trading it? No, I'm not. But yeah, I do see risk that's going to be happening. And if the tape starts to develop, then yeah, maybe I'll look into to get aggressive, but for a short-term move there. But I think people will be flipping and going long again at some stage. So it's a great chart, but I do feel consolidation is the name of the game. And looking at those stops for sure. That's definitely what you should be doing if holding those long positions there. Anyway, let's go to play of the day. Okay, I'm actually going to be looking at the HK50. If we are looking at volatility in equity markets, we've started to see it emerge once again in the Chinese equity market. The market had an 18% rally off those lows. It felt very fickle indeed. I mean, we'd seen some signs of better data coming through. We'd obviously seen authorities in China going after quant funds and any kind of funds who were looking at shorts. And maybe that caused a little bit of a move over on an artificial move. But yeah, we'd look like we've hit those targets now. We've hit those highs. We saw a reversal playing through. I want to leave sell stop orders below the daily candle here. Very, very small size. But when we see the uptrend breaking, then I want to add to that trade. And I think we'd probably revisit lower levels. I know the authorities will be going after, they're not going to be going after me, but they want to see the market higher, especially going into the MPC meeting on the 5th. So that's why I've said this is swimming upstream to an extent, because they want a higher stock market to increase confidence. But the market seems to be speaking out here, and I feel like the market is saying that we're done. We've had the 18% sort of relief rally playing through, and now it's time to start seeing markets rolling over again. So I like short positions here. You've got a stop loss just above those highs, which I've got the orange horizontal level. I can't exactly look at the number off the top of my head now. Small size here. If we break through that rising trend, I'll be looking to add and have a better position size there. But I think we've had the relief rally here. I think the market's saying it's not good enough. And I think they'd be happy to sell into it now.
All right. Well, Chris, I think you're right in saying that the Chinese bounces have been very shallow. I like to call it shallow, and that's usually not a good thing for bulls in this case. So anyway, great chart. I'm going to turn your attention to the Euro Swiss. This is my play of the day. Now, if you don't recall, back at the end of the year, I was really, really bullish. Well, let me take it this way. I thought that the Swiss strength was a little overdone, and we were looking for some reversals. I've been long Euro Swiss basically since the beginning of this year, and I've been playing it to the long side. I actually just took half my position off when we were at the 200 DMA yesterday, because we spent 2 days at the 200 DMA. However, I do think a big breakout's coming, so I am looking to buy dips and reestablish my long position at full down around the 94.80 level. If I can see that over the course of the next couple of days. This you may notice that Gartleys do evolve into butterflies, so I'm looking for a much bigger move up and towards parity towards the end of this year into the rest of 2024, and it's all going to kick off as Westy put on the 4th of March. Swiss CPI, weak CPI data that might put at risk that the Euro Swiss breaks that channel resistance that sits right at the 200 DMA. So really a break above 95.70 is hugely bullish. So Chris, that is my play of the day.
Yeah, I like it. And, I know it's just a bit of jest. You got to try and find ways to make money out of this idea about who's going to be the central bank that leads us off. And, it's usually the Federal Reserve who sort of take us and start the rate cutting cycle. But I think the Fed are probably more towards June at the moment. But could it be that we see the Swiss National Bank opening their door? And I think the Swiss National Bank would want to go before the ECB. The Swiss have been using their currencies reserves to effectively try and push back on the prior strength in the currency. So it's pretty clear that they would like to see a higher Euro Swiss. I mean, I think the Swiss National Bank would love to see that. And maybe they go off before the ECB just to try and preempt a rate cutting cycle in the ECB. So, yeah, I think that weak CPI number would be opening the door. And in this idea about who's going to lead us off, it could well be semantically the Swiss central bank who take us there. But I think that CPI number is going to be very important, and that would get you your trade. So definitely a cross that we need to keep on the radar, and a big catalyst there to come. Anyway, thank you, Mr. Morrow. Thank you for your time and your insights as always. And for everyone for watching, we really appreciate it. Leave a comment below. We'll try and get to those when we can. Smash the like button and subscribe to the channel, and it really helps everyone else find the show, which is great for us as well. So thank you all. See you next week.